Why you need to turn off financial journalism. It's too negative all the time. That's how they get you to click on their articles. So I want to share with you a couple articles, which I think you'll find funny. The stock market is even worse than you think it is. Now, this is Dateline, November 21st, 2018. There's a method to my madness here. The stock market is even worse than you think it is, and we're going to follow that up with the one from December 7th, 2018. This over here. A death cross for the S&P 500 highlights a stock market in tatters. All right, so let's start with this one right here. This is by a guy named is on Bloomberg by Stephen Grandel. Again, this is November 21st, 2018. All right, so what is he saying? The PE ratio of the S&P 500 based on the next 12 months of earnings is down 17% this year. Okay, so that's this is an ominous headline. The stock market is even worse than you think it is. The stock market is no longer not great, it's downright awful. In fact, after the 550-point plunge in the Dow on Tuesday, 2018's market meltdown, at least in terms of valuations, now ranks among the worst in the past decades. The PE ratio of the S&P 500 based on the next 12 months of projected earnings, all right, has fallen 17% in 2018. That's the third biggest drop in valuation since 1991, which is as far back as the Bloomberg data goes. That's only 1% point better than the 18% slide in valuations in 2008 during the financial crisis. The worst valuation drop was in 2002 when corporate profits in the economy, but not yet the stock market, were rebounding from the dot-com bust. All right, so what does this headline say? The stock market is even worse than you think it is. What does this say? In 2008, an 18% slide in valuations. In 2002 was the worst slide in valuations since Bloomberg started focusing on this. And now here, and basically November. Is that telling you anything? I mean, I'm trying to think if there's a better way to look at it, the exact opposite of what this guy's trying to tell us. Crazy. The S&P 500 now trades at 15.4, now remember, this is November, times what those companies are expected to earn per share next year, which includes the current one. That's down from 18.7 from the start of the year. It's also at the lowest point of Trump's presidency. So they're writing this as if it's a bad thing. I mean, if you're in the market now is not the time to get out. I mean, again, this is back in November because they're saying in 2008, 2002, and now the earnings have never been, the price earnings ratio has never been cheaper. And every time the previous 2 years, the two times, we just began a takeoff like unseen proportions. Which, lo and behold, is what happened in hindsight. I get it, but they're 15.4. All right. So again, and here's 2002, here's 2008, here's 2018, here's 1994. I mean, I can't think of a better time to be buying. Certainly not getting out. But again, the article is the stock market is even worse than you think. Yeah, but if you're already in there, it's too late to do anything about it now because you're already there. You already took you already took your lumps. Stay in there because, look, if you stayed in there 2008, if you stayed there 2002, you're loving life. The good news is that drops in valuations tend not to last long, especially big ones like this one this year. In a report last week, UBS strategists point out on average the market has returned 16% in the year after one in which the PE ratios dropped significantly. In fact, going back to World War II, there have been only 2 years in which the market has dropped after more, going back to World War II, there have only been 2 years in which the market has dropped after a more than 1 percentage point drop in valuations the year before. Parker predicts the S&P will rise to 3,200 by the end of 2019 because of valuations drop. On top of the valuation drop, he points to higher consumer savings, a rebound in companies investing in the U.S., and rise in productivity as reasons the market will climb. But there are also reasons to believe the traditional rebound won't materialize this time. See, it's always this time is different. Well, first of all, though, the absolute level of stock market valuations is not that low. It's pretty low. And S&P 500 15.4 is lower than historical averages. The PE ratio dropped to 12.8 in late 2008. Okay. The PE ended at a lower point than it is now in 6 of the 10 years in which there are big valuation drops. So what this guy is saying is, look, it could go worse. Yeah, you're right. But you're already, man, the bigger problem is that the elements that typically lead to a higher stock market valuations are vanishing. A strong labor market and tariffs will probably drive up costs, reduce corporate profit margins. On top of that, interest rates are rising and growth is slowing. I mean, the whole point. So I just find that funny. So no, you should have. I mean, I 100% agree with this. I say, look, valuations are low. If I'm getting a 15.4 PE ratio on the S&P 500 and I've been sitting in cash, I'm buying in. And heaven forbid, I get out of the market now. That'd be insanity. But I guarantee you many people did. All right, so let's see what this guy is saying here. Oops. And this is, he wrote this just a few weeks later, a death cross. So you're putting the death of the S&P 500 highlights a stock market in tatters. Again, the point is these are, yeah, it might be in tatters. I mean, it's down 20%. We're in a bear market. What do you do about it now? Well, I want to get out before it goes another 20%. All right, the S&P's, so he talks about the 50-day moving average was below his 200-day the first time since April 22nd, 2016. All right, so 2.5 years later. What did he flipping do? And what happened between April 22nd, 2016 and now? Well, the market went up, I don't know, 22%, something like that. The S&P 500 has joined the ranks of market benchmarks that form the dreaded Wall Street death cross. Oh, I didn't even care what it is. I never heard of that until I read this article. I was like, okay. Let's see. I just want to see. The formation marks the first time since April 2016. However, the last time the move for the benchmark comes amid a series of bearish patterns that have cropped up in equities. All right, so he's now saying it's bearish patterns that have cropped up in equities and fixed income markets, highlighting growing concerns of the durability of a bull run. Well, at this point, after the Christmas Eve massacre, the bull run was gone. Or bear market territories. Let's see. Thursday slump coming after a bond and stock market. Okay. All right. So number of strategists point out that a recent run of death crosses appearing in the market can be used as tools for those looking to re-enter beleaguered assets. We got this guy from IMG. Never heard of him. As I mentioned in the previous article about the death cross, the apparition of this infrequent omen does not necessarily mean the end of the world. In fact, it has occurred in the S&P 500 4 times since the start of the market cycle that began in March of 2009. Oh my! So I mean, it's occurred 4 times since 2009, which tells you there's nothing to be said about a death cross, and I don't even know what it is, and I don't care, but a death cross and impending doom, because we've had it 4 times. Not one time did it happen, and even after this, we had, 2 bad weeks after this guy wrote this article, and then after that, it's hell's bells. We've had a wonderful market. But as Market Watch's Tommy Kilgore writes, the ominous formation also a sign how viciously equity markets have unraveled. Let's see. I don't care what has happened. I care about what's happening, going to happen. With those unsightly technical developments at play, crude oil futures, the 10-year Treasury is at 2.85. 10-year Treasury is now at 2.3. So the 10-year Treasury has gone up a significant amount since then. The 2.39 is the yield now, off 2.85, which means the price is much, much higher. Bond prices rise as yields fall. A narrowing difference, we talked about the inverted yield curve. On their face, developments in bonds and oil suggest that investors are doubtful about the enduring health of the global economy for years to come. And then he does say, he throws a bone. To be sure, this may be a perfect opportunity for long-term investors. But presently, it may also appear that all is not right with this bull market. All right, so my friends, just stop. If you're worried about the markets and you're reading this stuff and you're like, oh, the death cross or inverted yield curve or what the other guys say, the PE ratios are down. That's all positive stuff, man. That means the market is declined. That means the valuations are lower, which means there's more future for upside potential. That's why you don't pay attention to stuff. All right, we'll see you next time.